Hi everybody, in this example and in the upcoming examples we are going to go over variance analysis. We are going to specifically look at a tops-down approach. We are going to look at what is the total difference of operating income between what actually happened versus what we budgeted or forecasted for. And then from tops down we are going to go down and understand what types of different variances that are out there. And for that we are going to use the following structure. Now, I know that the total operating variance income is $22,000 right here. Now, part of it is called because of sales quantity. I was planning to sell 1,100 units. I ended up selling 10,000 units. And the rest of it is called flexible spending variance, which goes further into manufacturing cost variance, sales price variance, SG&A variance, and so forth. So let's take a look at closer look at flexible spending variance versus sales quantity variance. What we are seeing here is we have the actual operating income. There's an actual sales price, actual quantity, and the revenue. We have actual unit variable cost and actual quantity, so actual total variable cost. And then we have actual fixed cost, and finally the actual operating income. On the right side we have all our forecasts. What we forecasted as sales price, what we forecasted as the sales quantity, the forecasted unit variable cost, and forecasted fixed cost, budgeted fixed cost. Now right in between we are going to write our flexible budget. And what flexible budget does is we are only going to take the actual quantity from the actual side, and everything else, the sales price, the unit variable cost, and the fixed cost will stay as we forecasted, and we are going to calculate flexible budget based on that. Again, flexible budget is nothing but taking the actual quantity from actual side and pretty much the rest from budget and recalculate the budget. If I do that with the budgeted sales price, with the budgeted variable cost, and with the budgeted fixed cost, my flexible budget income turns out to be $30,000. Now the difference between these two is just because the actual quantity versus planned quantity, and hence the difference is sales volume difference. Now I know that I was planning to generate $36,000. Under flexible budget I generated $30,000, so it's $6,000 less just because of volume. The rest of $16,000 difference between actual and flexible budget is what's known as flexible budget variance. Hence, I can go back and rewrite, okay, my total variance in my operating income is $22,000. Sales quantity variance is $6,000 right here. And flexible spending variance is $16,000. Now what we are going to do is we are going to further look at the 16,000 and see how they are distributed around manufacturing cost variance, sales price variance, and SG&A. Now let's assume there was no SG&A variance. What is the sales price variance versus what is the manufacturing cost variance? Now, sales price variance is nothing but the actual quantity multiplied by the price difference. We were planning to sell for $100. We ended up selling each item for $99. So there is $1 difference, not favorable, -1, over 1,000 units. So there is a $1,000 unfavorable price variance, sales price variance. And please note that we assume there is no SG&A variance. And let's go back again to our original sheet. So this was kind of 0. That's what we assume. Sales price variance is 1. So that means manufacturing cost variance needs to be 15,000. Let's go back and check and make sure that manufacturing cost variance is actually 15,000. Manufacturing cost variance is nothing but the variable cost difference between actual and budget, and the fixed cost difference between actual and budget. And if I look at that, the variance on the variable side is $5,000. On the fixed side, it's $10,000. The total manufacturing cost variance is $15,000, which kind of verifies our earlier point. So we know that the manufacturing cost variance right here is 15,000. Now on the next example, we are going to further go into, okay, we have $15,000 variance. How much of it is because of direct material, how much of it is because of direct labor, and how much of it is because of overhead cost? And in the next example, we are going to calculate that.